Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, December 29th, 2021. It's 10:35 Eastern Time as I'm starting the video, and what I'm going to do is cover the broad markets. We'll do an update there, of course. Brief update on the precious metals because I got some posts out to you this morning, and then updates on some of the other commodities and other things I've been highlighting recently, such as lumber, coffee, and treasury bonds. We'll probably keep it in those. May stick on the commodities, might just stick to the futures to streamline the video. I try to mention when possible the ETF alternatives, even if I'm covering the charts on the futures. Quick side note, want to apologize for being out the last 2 days without advance notice. It is, the holidays. My wife is off work. Her company always gives everyone the last, I think it's 10 days of the year off. They shut down, like a lot of companies do around this time of the year. Kids are out of school, of course. And we had an impromptu vacation where we went by boat from the mouth of the Caloosahatchee River in Fort Myers all the way up to Lake Okeechobee in the middle of the state. So I didn't have the ability to post anything or follow the markets. We had to traverse 4 locks to get there and a couple drawbridges as well. So it was an all-day trip there and then overnight on the way back. So my apologies again, although I imagine half of you aren't doing much now. And the other thing, I'm going to get into this as I cover the charts, and I should have done a better job of mentioning it this year. I usually mention it each and every year. When you get into the week between Christmas and New Year's, volumes plummet. There's not in whipsaws are the norm. Again, I'm going to get to the charts there, but what I'm getting at there is you take the moves, especially in the equity markets, with a little bit of a grain of salt, because again, for that reason, you tend to see whipsaws, meaning dips down through support, above resistance, and false breakouts. They tend to increase. With that being said, let's dive into the charts. I'm going to start out here with the long-term monthly chart because I've been focused on that quite a bit recently, and we'll go through the 3 big ones that I follow as far as indexes. That's QQQ, SPY, and IWM, or the Russell 2000. So here's our big bull market primary uptrend line from 2008 and QQQ. Every other index bottom in March of 09. And again, from this charting perspective, forget about that bear market and any others that we had there that were drops of over 20% from high to low. They were really just corrections within an ongoing bull. By most accounts, that bull looked to have breathed its last breath when COVID hit. Charts were indicating that, but again, the amount of stimulus into the markets and the financial system as a whole have given it another leg up, another boost of a lot of big boost of fresh air there. All right, but what I'm looking at here, and again, this is kind of a recap, so hopefully you've watched some of my recent videos. I talk about the PPO histogram just being a great trend indicator and showing you these. When the PPO crosses over on the monthly time frame, you get these red bars down here. Those are the periods of the corrections, each and every one. They're labeled here 26%, 24, top to bottom, 31. Yes, if you were going back and looking at the NDX, the NASDAQ 100, it did not fall a full 26% high to low, but the Qs did, because they're an ETF and they don't always do a perfect job, especially when there was a flash crash in there. So that caused the Qs to drop from high to low down to 26%. And again, even that little blip, it was not a whipsaw. It was correlated with a 31% drop. Now, these are not timing indicators, but they are, to me, just an excellent way to look at, kind of get an idea on where things are headed, where the larger trend is going. And as I always talk about, you get these hills, these mountains, these green hills. That's when the momentum's strong. The PPO line is well above the signal line, and then momentum starts to wane. And when you are headed down, you can see a clear trend down towards the zero line. Invariably or inevitably, you're going to cross over. You're going to get a cross, and you can see it's unmistakable. The momentum's been waning. Yes, we're in a bull market. Yes, the trend's bullish, the primary trend here, but you can see this PPO is poised to cross over. So I still believe it's coming. Once in a blue moon, the lines bounce down at the end. And if you guys remember, before I left on or last week it was, even though I had to take a couple days off last week as well. We had a red histogram bar But if we close where we're at today, it's going to be green. But again, so we won't have the sell signal at least on QQQ unless we have a drop now before the end of the month here. Next what 2 days trading left. But it looks inevitable. There are no guarantees, and again, it's not a timing indicator. We're going to get that in a second. We're going to look at the daily and 60-minute charts. But I just want to give you the overview, and it certainly looks like we're going to get that crossover soon, based on the the rate of descent here, where these bars are. All right, so that's that, and we'll look at SPY. SPY's in a little bit better shape. Remember, QQQ is tech heavy. We're looking at almost certainly a rising rate environment coming up in next year, and that tends to not bode well for tech stocks. They tend to be more rate sensitive than some others. But you can see we are declining here, but there's room to go on SPY before it triggers, before these bars cross over. Now, sometimes you can have a quick drop like you did back here. It looked pretty healthy right there. And remember, by the time the bars cross, that's after the top is in usually. So you can see we peaked, back here several months before you got the crossover in the histogram. And so just something to mention, that they're all pointing down. You also have the big divergences on the monthly, and then small caps as well, same thing. And you can see clearly on the small caps, I mean, it's just unmistakable, that rate of descent right there. It looks like a crossover is inevitable, as it was back here, as it was there and there. And again, you can do this on your own. Go and measure these drops, pull a monthly chart, put up the PPO. If you don't have a PPO, you can use a MACD, but a PPO is going to work better on a longer term time frame like this, in my opinion. So that's it, and there's where we're at. That's kind of macro or long term, bigger picture. Let's zoom down. Let's skip down to the daily so this video doesn't go too long. So on IWM now, as far as price goes, you have this range that has to be taken out if you're looking for a reason to get short and stay short. And I have a pretty aggressive target, but what I call a high probability target. I think it has a high chance of being hit. Nothing straight down. I'm not drawing all the squiggles, but that's 170 is my target on IWM, which where we're at right now is about a 24% drop. But the break needs to come below 208, a solid break there. And obviously it's going to help to see the large caps break down as well. So that'd be about an 18% drop if that's broken out. Now, hey, maybe things go the other way. Maybe that PPO bounces. Maybe we have another big thrust up in the market. If so, you want to see a breakout above the top of the range. We already had one breakout, which proved to be a false breakout or a whipsaw so far. But other than that, a lot of reactions there. So that's the bigger picture. And until then, look, it's going to be noise, or you're going nowhere if you're investing. Let's say you're an investor and you have money in a small cap fund in your 401k. Well, you have gone nowhere now since the beginning of 2021. That's when we've been in that range, and that's where we're at. So for a trend trader wants to see a breakout above or below. If the breakout either way, if it happens down below, we'll look at the shorter term charts as well to see if they confirm. And if the breakout happens to the upside, we'll analyze the charts to try to determine if the breakout's going to stick or if it's going to be another whipsaw like that and a move back down. And the SPY S&P 500, here's our trend line off the March lows when COVID first hit. We've had a couple trend lines, but this is the one. I'm not crazy about any of these because we have a nice reaction there. A couple reactions recently, but not super clean. More importantly, probably the thing I'd put the biggest emphasis on, and I've been talking about for a while, is that 453-ish. I have it at 453.75. That's that previous all-time high there. We had a pullback, then we had a breakout. We successfully back tested it right here recently and again, and then we had this range we set up, and I talked about this. Now, on face value, a breakout above the top of the range would be bullish, and that's what we have right now. So if you want to be a purist and take the charts for what they are, then you go long here on the breakout, and you can put a stop somewhat below. I talked about this before. I said I could see the possibility of another new high, because if we got it, we're guaranteed to have divergence, and that's what's happened. So since I left, we had the breakout. We had the breakout here on Monday, and yesterday we had another. We stayed above it, and we're still above it right now. But that is just basically take the divergence right now and move it up to there. Here's our divergence line, and I say this often: breakouts that occur with negative divergence have a much higher rate of failing. So I still suspect that breakout will fail. And also take it with a grain of salt because of the holiday volume. You can see here's the volume. I don't know if you can make it out. I'm showing you the lines right here. These are my volume bars, and you can see volumes tapering off. Everybody's, not everybody, but a lot of people are on vacation, and what a lot of the little volume you do see is just year-end tax shuffling. So it's really, again, take breakouts. Even a breakdown, you'd have to take it with a grain of salt. So that's still our levels to watch. Right there is about, I'm going to move this line. Well, I'll just give you another line. If you want to set a price alert, let's say you don't want to sit in front of the computer all day, set a price alert, I'd say around 450. I think if 450 gets taken out, that should do it. But you'd also want to see comparable support levels on SPY and IWM, ideally. Large caps are going to do their own thing. So 450 on SPY, and then QQQ. The trading range, I'll box it in here, give you a little box right here. And you have a couple spike lows down there around, let me give you a line. This chart's getting a little bit busy, but 377.64. We'll call it right now. I'll make that yellow. So in a nutshell, if you turn off all the lines, what you had on QQQ, you had a previous high right here, right? And then you broke out above it. You had a breakout. Let me draw a line there. And then 1, 2 successful back tests so far, but we're still grinding around. And unlike SPY, QQQ has not taken out that high. It has not taken out that bearish engulfing candle that we put in a few weeks back. So there we are. And if it happens to, if there's a little pop into year end or first week of January or so, we are guaranteed 1,000% if it happens soon to have just an even larger divergent high. We had a divergent high right here, and if we get here, we're going to have an even bigger divergent high. So again, it's a breakout that you might not want to chase, but look, you want to play it objectively, take it on face value. Again, well, we didn't break the previous high, but if you are bullish and you went long on this divergent low, which in hindsight, yeah, that would have been a great time. I mentioned as an alternative scenario, I highlighted the divergence. I didn't think it would play out for as much as it did, but again, that's what you get in December, and that's also what you get me for ignoring one of my primary rules in trading. In a bullish primary trend, when you get 60-minute divergent lows, that is almost always a catalyst for at least a good rally, if not a breakout into leg up to the new highs and beyond. I was suspecting this one might fail because of the holidays. Those divergences might get burned through, but they didn't. So that's that. And again, that's why we diversify. I went away and I've given these guys room. I've put on swing shorts on the indexes, and it sucked to see all those gains. A lot of those gains evaporate like that. But I've made 5 times that, 3 times that or more in the metals. Alone that I highlighted today, with palladium up 31% off that low from December 15th, just 2 weeks ago, in the markets at the same time off their lows. Even the Qs, which were stronger, up only about 6%. So again, that's I always preach the benefits of diversification, just as important in active trading as it is in investing long term. Okay, so while we're on the 60-minute charts here, a couple things to look at on SPY and QQQ. Maybe we'll get to IWM. Steep and pretty well-defined uptrend lines. There they are right there. You can see an uptrend line on QQQ, which has now been broken. A lot of reactions there, and so that is a sell signal if you want to take it. And also, you have a little arrow here. This is what I call a high-level PPO, bearish PPO crossover. So there's a zero line over here, right there. And so when you get these high-level bearish PPO crossovers, they usually mark tops. You get corrections that follow. I'm circling all of them right here, the last few that happen above the zero line. 1, 2, 3, 4. So where did you want to be when that happened, long or short? And you can see what happened then. So that's a case to either be short, get back short if you got stopped out. There's nothing wrong, and probably would have been great if you would have gone long and reversed at that divergent low with a stop below. I mentioned that for bullish long side traders. I even went on as far as to say this was right here, that divergent low on the 60-minute chart. I said by far the most bullish setup I've seen in a long time, in months, and it certainly played out for a big run. But that run has probably run its course. We'll see. Anyways, I just want to point that out. Oh, and levels to watch, 401. Remember 401 before I left, I said was a big level. I really didn't want to see this rally get above. Well, we popped it. We also popped it on very low volume, almost no volume at all. So right there, and I always say this, any breakout above support or breakdown below resistance or breakout above a bullish chart pattern, you want to see on above average volume. I like to see 1.5 times or better the average volume. That's the average 60 or 90-day volume. And this was the opposite. This was almost no volume. So that doesn't mean the breakout didn't happen. Doesn't mean it cannot stick. It doesn't mean that at all. It just is a sign of non-confirmation. It's not a validation. It was not confirmed on volume. And so now what we're watching is, let's see if it fails. A solid move back down below 401 would mean the breakout failed, and then you have what we call a bull trap or a false breakout, and that could send us a lot lower. We could head on up here, take out, make a marginal new high, extend the divergences, and put smaller divergence here on the 60-minute. There's a lot of things that can happen, and I'll do these updates. I'll pick back up on them, but right now let's just see if the breakout above 401 fails. And let's look at the futures while we're on the NASDAQ. Here's what I've been tracking here. This is a 60-minute chart. Remember, we had our bearish rising wedge right here with a breakdown there, and the big level to me was and still is 16. I have it at about 16,424. We'll call that 16,425. Again, big level to me because we had so many reactions there. It was a major reaction high there, several reactions. False breakout that failed, and once it failed, every single back test of that level, boom, 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 failed. But this, so now we broke out. This is the onus is now on the bulls. That is a breakout. The bulls should step in here and buy it. The back test, I'm going to point it out as an objective entry. I'm going to point it out as an entry I'm not taking because I think it'll fail. Again, if I was a purely mechanical trader, I would be buying here. And again, if and maybe my analysis will prove to be wrong, and we do take off from there. But you can step in and buy with a stop. If you're, like me and a little leery of based on everything that I've covered, or for whatever reasons you think the market's not going to go much higher, then you can wait for a solid break back down below there to take short positions or add to or re-enter. Let's say you went long here at the support. Remember, we had major support. It was a price target hit, positive divergence. That was that bullish falling wedge, and we broke out, and there's a price channel. So this is the current technical posture. Nice clean up trend line, just like on QQQ I showed you. Really formed a price channel. We broke down. We had small divergence, not much, but usually if it's a counter trend rally, that's all it should take and can take. And that's it. So if you break it, look, we've been in this range for a while. Usually when you go to the top of a range, if you get rejected, you're going to come back down to the bottom. And no range lasts forever. So this is the bigger picture. Keep showing you these ranges, and you see them as well on the daily chart. If we can if we can take out the divergence, look, let me show you this. Anytime soon, let's say I draw this line like this one here, we're still going to have a divergent high, even if we go up to challenge this previous high or make a marginal pop, especially on the daily time frame. And so if we do start moving lower, if we break back down below 16,423, we start running down there, this will be a big level. It was a big level to me before, that 15,536. We hit it here. It was a target. We bounced off that level. But the fact that we've had now such major, these are big reaction lows. You can see that's the bottom of the range here. We swing back up to the top. So if we break that level, I would give it a pretty high probability that we're going to go and hit my if things get ugly target all the way down there at 14,423. So first things first, that has to happen. Let's see what happens if we do this. If we keep going up, we can burn through the divergences, and that's nothing but bullish, guys. If we burn through the divergences, especially on the daily time frame, then that's very bullish price action. So that hasn't happened yet. We'll just have to watch. And next up, SPY. Hey guys, you know what I'm going to do here? I'm going through these charts a little bit more in detail than I thought. So I'm going to wrap this after I finish IWM. I'll cover that next. So we'll keep this video limited to the indexes, so you don't have to watch a 40-minute video. And then I'll do updates on the commodities and other trade ideas in the next video. So on SPY, Same thing, really big multi-month trading range right there with a recent breakout. Take it on face value, it's bullish. You can go long, but again, if you take it with a grain of salt because of the low volume around the holidays, you might want to hold off and wait and see if it sticks. Or if you're bearish, wait to see a failure, a solid break back down below. Top of the range is really about 473 right there. Before I had a line of color coded at 470, almost 471, but this is really the line that we need to be watching now, because that's as I always say, the charts are dynamic, and so is my analysis. Charts evolve and change every day. These are the two reaction highs right up there, about 473. So that's it. So like NQ and QQQ, we had a nice, very clean, well-defined uptrend line, a steep uptrend line in SPY. That uptrend line has now been broken. We also have a high-level bearish PPO crossover right here. Meant to do the circle tool, just like we had one right there. And that's about where we topped. We got the crossover there. We didn't go anywhere, and then we started to fall. And then another crossover right there. And it was a little clear on QQQ, but anyways, just wanted to mention that. And again, the big level down here at the bottom is about 451, call it 450. That's the bottom of the range. And then you have ES, the S&P 500 E-mini futures. Down here on the PPO, we had a divergent high right here, right, on both the PPO and RSI right there. That was our last divergent high. It was at resistance, a big level too. It was top of the range back then, 47.31. So what happened when I was out? Well, we popped it. That's a breakout. And again, you could take it on face value, or you can take it with a grain of salt. It's up to you. If you take it on face value, you want to be long there, or a back test to 431. And if you're bearish, you want to see a solid move back down below 47.31. And so just like QQQ and SPY and everything else, you have a clean, well-defined uptrend line which has been broken. They're not really selling it hard so far on the break, but it is a break. So let's just see what happens. And the divergence is still very much intact on the PPO. It's almost there. It's pretty much flatline divergence on the RSI, so that's why we still have a divergent high there. And so that's what you're looking for. This is now the battleground. Bullish if we can hold above 47.31. Bearish if we make a solid breakdown below it. And then what to watch for there? Probably the key level to me would be this uptrend line. We'll come down to that trend line, and if we break that trend line, that should take us down to that target there, about 44.64. And like the other two indexes, QQQ and SPY, RTY, which are the small cap futures ETF, or small cap futures. I'm sorry, the ETF is IWM. You had a nice, clean, solid, divergent low. You also had a whipsaw, little false breakdown through the trend line, and that's what happens when a breakdown fails. It's what we call a bear trap. So you went down below it. But in doing so, put in that divergent low right there, and then they gunned it up, and they took out the trend line. We had a downtrend line, so there's also a breakout on IWM or RTY. But right here, this arrow I'm drawing, these are the previous reaction highs were at resistance. And so, I'm suspecting a turnaround, but keep it light. It's still the end of the year, just a couple trading days left, so no reason to get overly aggressive, especially in the equity markets. For some reason, the commodities seem to have more pure charts. They don't seem to be as whippy. They seem to trade better during the week of Christmas. Again, I think that's probably a function of the fact there's more professionals in there than retail traders, but I don't know. Anywho, this is IWM, same thing here, 60-minute chart, nice, strong, clear, positive divergence, that divergent low, and then we took out, the trend line is kind of, if we could do it like that, either way, but you had and still have quite a bit of resistance overhead there, so PPO is starting to cross over. Last time we had a bearish PPO crossover was right here, and you can see what happened there. But just to take it home here and wrap it up here, just don't forget, like so many like SPY, to a lesser extent on SPY and QQQ, bigger extent on IWM, we're in this trading range. And when you're in a trading range, As far as swing trading goes, especially investing, it's going to be choppy. You're going to be frustrated because you're going to go nowhere until you clearly put that range in the rearview mirror. So right now, based on the shortest term charts that we covered, the 60-minute charts, we have broken those trend lines. We have the bearish PPO crossovers in play, and so that would put me short right now. If I just came back into this and I had no positions, again, not overly aggressive. And then if we fall back below those breakout levels I just showed you that popped the last couple days, then I would add to those shorts and just trail stops down or set stops above the recent highs and let it run. That's how I'd work it. Likewise, I showed you levels if you're bullish, where to go long with stops below. And at the end of the day, if you do the long or short trade and you get stopped out, don't be surprised, because you still have a few days of low volume trading, and that's when things can get a little whippy and stops get run quite often. All right, guys, I'll wrap it up here and then follow up shortly with videos, at least one video covering some of the other trade ideas, such as commodities. This has been Randy Finney with Right Side of the Chart. Have a great day.